This video will cover monetary policy. Monetary policy includes the actions the Federal Reserve takes to manage the money supply and interest rates in order to pursue their macroeconomic policy goals. And these goals include low unemployment, stable prices, so not too much inflation, and moderate long-term interest rates. Since 2012, the Federal Reserve has set a target inflation rate of 2% and uses monetary policy tools to try to achieve this goal. The monetary policy tools that the Federal Reserve uses is changing the reserve requirement. Remember, the reserve requirement is the percentage of deposits that banks have to have on reserves at all times. So currently the Fed has set the reserve requirement at 10%. And this is, I think, the monetary policy tool that the Fed actually uses the least. Another thing the Federal Reserve can do is change the discount rate. The discount rate is the rate at which banks can borrow from the Fed. So if they're short on reserves, they can borrow money from the Federal Reserve. The last way, and the most common way that the Fed conducts monetary policy, is to use open market operations. When the Fed uses open market operations, they set a target for the federal funds rate. The federal funds rate is the interest rate that banks charge each other for very short-term, like overnight loans when they're short on reserves. And that's different from the discount rate because the discount rate is the rate that the Federal Reserve charges to banks to borrow. And the Fed acts as the lender of last resort. So the first thing that banks try to do when they're short on reserves is borrow from other banks at the federal funds rate. So the Federal Reserve will set a target for this federal funds rate, which is determined in a market, and they'll conduct open market operations, which is the buying and selling of government securities, so treasury bills, bonds, etc. And they'll conduct these open market operations, the buying and selling of government securities, until that target interest rate is achieved. Lastly, and this has only been used since the Great Recession from about 2008 to 2009, another tool that the Federal Reserve has used in monetary policy is interest on reserves. And so when commercial banks hold some of their reserves at Federal Reserve branches, the Fed will pay them interest on those reserves. And so that's essentially their return to holding that money there. And so if that return rises, then they have more of an incentive to hold on to excess reserves and loan out less and make fewer loans, which would decrease the money supply. If the Fed decreases the interest that they pay on reserves, then commercial banks have more incentive to loan out their money instead of holding on to excess reserves, which would increase the money supply. So now we're going to look at the demand and supply for money, so a money market, to see how the Federal Reserve buying and selling government securities, which changes the money supply, can affect interest rates.